It's a fairly basic question. I don't know some of y'all's strategies. Some of y'all look like you're not a member of a team, so that kind of bothers me. It's kind of a wasted opportunity for networking. And also, you got to do this exam question in just a couple of weeks, so it'd be a really good time to be engaged. But I can't control that, but I would highly recommend it. So the first thing you got to do is a holding period return, which is usually monthly. So which months can you calculate here? Yeah, September, October, November. So the holding period return, very, very simple formula. So you're going to take ending market value minus beginning market value plus income divided by beginning market value. Very simple formula. Yeah. So for November, it's going to be 153.52 minus 150.03. How much income in November? None. Divided by 150.03. So a pretty decent month, 2.3%. In October, you've got 150.03 minus 145.86. How much income? 94. It's X states, so you get the 94 cents in there divided by 145.86. So a really strong October. And then September, 145.86 minus 154.34 divided by 154.34. So kind of a bad 1 month there. So there you're holding free returns. Those look familiar. Is that what y'all got? Mm-hmm. All right. And then the Aerith on the exam, you'll just add them together. And here's where I say, you could do the entire exam in decimals. You don't even have to put the percents, but if you do, convert back and forth. So minus 0.0549 plus 0.035 plus 0.0233 divided by 3, right? The average for those 3 months. Not much of a return, but not terrible. And then annualized with a footnote. The exact same formula. You're going to take that whole thing and multiply it by 12. 1.36%. That look familiar? And what's the asterisk say? The institute is not annualizing periods less than a year. And then the geo, a little bit more work, right? And here you probably want to collect this as you go. So 1 minus 0.0549. So you end up with like about 94 cents at the end of the first month. But the next month, you're going to make 3.5%. So you're kind of back up to 98 cents or so. And the last month, you make 0.0233. All of that, what? 1/3 minus 1. So that gives us that geometric average. It should be smaller than what? Should be smaller than that, right? And then you annualize that. So you might, on your computer, you might enter that number down before you do the end of it, because you're going to do it again, but instead of 1/3, you do what? 12/3. If it was weekly, 52. So that one can be higher than the arithmetic, but the monthly cannot be higher than arithmetic. And you have the same footnote. Bloomberg will annualize. If you pull up the COMP function in Bloomberg, is a wonderful function. I use it all the time. It gives you returns, and you can pick the period. It will annualize any period you give it. what I gave you for paper 2, the annualizer is in there, but I just didn't put it in the picture. Because it's, I gave you 1 day and they'll annualize 1 day. I mean, it's amazing, but they don't put the footnote, but you're not supposed to. But the COMP function is pretty powerful. All right, so that's everything. There's 5. Well, you need that. You need these 2 numbers, those 2 numbers. So you essentially need 7 numbers. You'll do this a lot in investment, calculated returns. The computer will do a lot of it. Your custodial bank will do some of this as well. But you need to know what the actual underlying returns are. The holding period is the key one that we're not following the rules because according to CFA, we're supposed to use modified Dietz. This is not modified Dietz. So this formula is simplified. These other formulas are correct. These are the correct formulas. That's how you do arithmetic and geometric averages. But the holding period return, we should be using modified Dietz, but to keep things simple, we're not going to.
Go back to the gear formula.
Yeah, so there. Questions on that? Should be 100% for everybody on that one. It's pretty basic calculations. All right. So we want to finish up on beta, and then I want to get an evaluation of bonds, which I think is actually really fun to do because I can show you duration real directly. So last class we talked about there's 2 risks that are part of standard deviation. Standard deviation is your total risk, but it's measuring both systematic and unsystematic. Beta is measuring your relative systematic risk. The unsystematic risk is stuff that's specific to your company, maybe specific to an industry. But last week when we did our dashboard, we saw one stock jump 10% because they hired a new CEO. That would be unsystematic risk, specific to that company. A new product, new markets, competitor does something gets approved, some disaster hits the headline, whatever is going on. And the capital asset pricing model says you can ignore those risks because if you have 20, 30 stocks, if a company has bad news, you're just as likely to have another company with good news and they'll offset each other. And that risk just completely disappears. So there should be no risk adjustment to your risk premium for unsystematic risk. But if you have a private company, that's not true. If you're Mr. Butt, you own HEB, if you were still alive, he doesn't have a diversified portfolio. His risk is all in HEB. He cares about unsystematic risk. Bill Gates probably cares about the unsystematic risk of Microsoft because that's a huge part of their wealth. In that case, you do care. So this only applies, CAPM only applies to stocks in a well-diversified portfolio. All right. So why do companies go public? So I don't know enough about HEB, but would HEB go public? Let's say their free cash flow is, who knows what it is, but let's say it's $300 million. And their discount rate, because it's a private firm, it's going to be really high because they have to include all risk, systematic and unsystematic risk. For typical company, systematic risk is like 15, 20% of the risk. Most of the risk is unsystematic. So for a firm like that, they may use a discount rate of 20%. Let's say they're growing at, I don't know, 5%. So what's the value of this firm? Well, you take free cash flow divided by KE minus growth, and you get that they're worth $2 billion. What if they go public? What will happen to their discount rate? You're gonna ignore 80% of the risk of the firm to discuss discount rate. What discount rate would you use for a grocery store? They may not be a grocery store. They might be a real estate company. But if they were a grocery store, would you use a high discount rate or a low discount rate? Pretty low, right? Low betas, so maybe somewhere around 6%. What's going to happen to the value of HEB if they go public? It's going to jump up 5%, 10%, 20%. What do you think? How about 100%? 100 times, not 100%. If the Butt family were to go public, their wealth would increase not 10%, not 100%, but 1,000-fold. What do you think the little Butts are thinking? So some little Butts out there with $50 million, and they know if they go public, they'll now be worth, I don't know, 50. I mean, see, they got 50 million, 100-fold, they'd be worth $5 billion or something. Do you think that little Butt would like to go public? Well, do they care? Is control that important when you got 50 Butts? It might be important when you got one Butt, right? And you got Henry Butt. But when you got 50, 100, like the great-great-great-grandchildren, they're like, I got control over 5% of this company. You think they care at that point? If their net worth is going to go up 1,000-fold, would they rather say, hey, you know what? I give up control because so that's the reason Zuckerberg went public. When Zuckerberg goes public, his net worth increases 100-fold, 1,000-fold. Why? Because when your stock becomes public and it's part of an overall well-diversified portfolio, the discount rate drops not a little bit, but a lot. So this is the reason firms go public, because that discount rate goes down so far. Bill Gates, when he has his investment, 80% of his wealth, 90% of wealth in Microsoft, he cares a lot about the unsystematic risk of Microsoft. But once he goes public, it's well diversified. He can sell off shares. He can get some of his wealth out of it. We'll look at this more when we do some more betas. We'll talk about the diversification effect. I might be able to show it to you now. I might wait till next class, till Wednesday to show you. So I've seen questions like this on the exam. If you see like this type of question on the exam, you need to protest the professor. So let's say, I've heard some people say, wow, 2008 was a really bad year. Stock betas must have risen. What was the stock beta in 2007 of the stock market? What was the beta of the stock market in 2007? It was 1. What was it in 2008? It was still 1, which means could betas have risen in 2008? They did for some companies, but if they rose from some companies, what did they have to do for other companies? They had to fall, right? So yeah, you might have seen in 2008, bank stock betas went from like 1.5 to 3. Why? Because of the financial crisis. Bank stock betas rose, but what did you see Walmart beta do? It dropped even to negative. So you can't say, wow, betas must have risen because we had a crisis. No, because beta is always 1 for the market, and the average of all the betas of the stocks is going to be 1. So if you have higher betas, you have to have lower betas offsetting it. I have seen this question really commonly. If a stock has a beta of 1.1 and the stock market rises 10%, is the stock going to rise to 11%? The answer is you don't know. Because beta only covers 20% of what's going on with that company. They could be up, 50%, they could be down 50%. The beta is only saying the part of their risk that's related to the overall stock market. So you can't answer that one. You're going to see when you do paper 3, you're going to be using a video like this that calculate rolling betas, which I highly believe in. We'll get a little more practice with those, but I'm going to actually walk through paper 3 and 4 in class doing probably Walmart. All right, so how do you get beta for a company? So you can go into Yahoo Finance. If you want to do Walmart, you could go into Yahoo Finance and get Walmart's beta. There it is right there, 0.5. Does that sound like a reasonable beta for Walmart? Did you expect it to be below 1 or above 1? Below. It's definitely defensive. 0.5, that's possible, certainly possible. But what is this beta? It's just the beta for the last 5 years of monthly data versus the market. That's all it is. I showed you last class where I did a longer period of time where you could see it was much higher when it was a small company, but 0.5 is definitely in that range. That makes some sense. But that's historical beta. Well, we're not using historical beta. We're going to use a forecast of beta. It's a real key from my belief. Beta is not a statistical number you look up. Beta is a number you forecast. The statistics just tells you what their sensitivity to market has been historically, but you want to use a forecasted number. So how do you forecast it? 4 steps that you'll do on exam 2. It's kind of the only kind of essay kind of question, although it's a really short one for exam 2, very different than exam 1. Now, this has been my approach for years and years and years. I was a little nervous at first because I thought I was the only professor doing this. And then I watched Damodaran's class. He does the exact same thing. Not that he's copying me. I didn't copy him. It just happens. I mean, it's amazing. Exactly the same 4 steps. So I don't know how he came up. Maybe he did watch my class one day. I seriously doubt that. But at least I got his support. And he's kind of the evaluation guru for beta. So it gives me some confidence that this is a pretty well-respected approach. So the first thing you do on the exam and for your paper 3 is you decide what kind of firm is this. Is this a defensive firm or a cyclical firm? It's a defensive, its beta is below 1. It's cyclical, the beta is above 1. So what's defensive, what's cyclical? So Ford should be a cyclical company, sells a consumer discretionary, a high price product. People are going to cut back on that in the recession. And that's the main way I think about it. We have a recession, people are going to spend less. Which products will they spend a whole lot less on and which ones not as much? The ones that they're really going to cut back are going to be your high beta companies. The firms that they don't cut back as much on are going to be your low beta firms. All right, so you start with that. I call it revenue sensitivity. How sensitive are their actual business? How sensitive is that to the market? All right, start with that. Pretty straightforward. Here's my typical list of betas, although I changed my mind some. So energy, I tend to think low to medium. People tend to buy gasoline, other energies, I guess natural gas. I mean, I guess it's possible with a recession, we have a freezing cold winter. People may cut back a little bit on heating, but they're not going to freeze to death. So they're going to still buy it pretty consistently. Materials, that is a high beta industry. Things like steel, concrete, those are things, and materials include chemicals. Those tend to be production assets. People tend to cut back on those in recession because everything is slowed down. Industrials, almost by definition, are high beta. You're building big trucks, whatever you're building something massive. So that's going to be a high beta. This new industry, consumer communication services, that used to be media, it has such a combination of bizarre companies. So you've got telecom in there that used to be low beta. You've got Google, you got Meta in there. You have Disney in there. It's such a group, but I tend to think of those as typically high beta, although telecom tends to be lower beta types of companies. Consumer discretionary, almost by definition, is higher beta. Consumer staples, by definition, is low. Healthcare is usually lower, but it can be a little bit higher. Financials, it kind of depends on what's going on. So if you think about a recession, banks are going to struggle with bad debt, loan charge-offs, those type of things. That's going to hurt them. Credit card loans. Life insurance and property casualty companies aren't as sensitive to recessions, but they can be. But it tends to be 1 or higher. But in 2008, banks especially, their betas jumped up to over 3, pretty much overnight. So yeah, you can see some pretty high betas in some years. Tech used to be high beta, not so much now because tech has become so big part of our life. There's some people that would give up their heating and electricity before they give up their Apple phone if they figure out how to charge it somewhere. We've become pretty addicted to tech. I still have a lot of students that are smartphone zombies. It's like their social media owns them and it just kills them. So we've become so addicted. It's kind of like tobacco used to be low beta, but now tech has become our addiction, and maybe its beta is falling. Real estate typically is a high beta, but not all real estate. It depends on what kind of real estate you're doing, but it tends to be higher beta. And the utilities tends to be very, very low beta. But you can debate all of these. We may have talked about this for Ferrari. Is Ferrari high beta or low beta? We talked that earlier. You would think high beta because it produces cars, but who buys their cars? Billionaires. Are billionaires worried about a recession? like, oh man, my net worth fell from 50 billion to 40 billion. I don't think I can buy a Ferrari this year. You think that they think that? Not at all. So you get the Motor Inn actually argues that Ferrari is a low beta company because its clientele is very insensitive to the economy. So you can make these special types of arguments. What about Netflix? High beta or low beta? So are people going to give up Netflix first or last in a recession? They're probably, and now Tim Andren spoke to us about cinema. Is cinema high or low beta? He argued cinema may be low beta because of all the expensive things people do, the cinema is not that expensive relative to the others. I haven't been to a movie in years, so I don't really know. What are ticket prices now? Like $15 or something? They're really ridiculous. So who knows? But he said it's still cheaper. I mean, have y'all seen ticket prices at Disney theme parks?
Yeah.
A family of four, what's that going to cost you? You got to mortgage the house to go on vacation. It's ridiculous. So a cinema is not that, I still think of it as a high beta. It may not be like 1.8. So you can debate some of these things depending on your philosophy, but you have to have some rationale for your argument. All right, so the first thing is to find your company. The second thing is, okay, their main product is a defensive or cyclical, but then you're asked, how volatile is the net income relative to revenue? And that comes to fixed costs. And there's two types of fixed costs. There's operating leverage and there's financial leverage. So operating leverage, that has to do with fixed costs and their structure. Does this firm have high fixed costs or low fixed costs? So what is a high fixed cost? You have a lot of salaried workers. So NVIDIA, how many hourly workers does NVIDIA hire? Probably not too many, maybe a few, but not too many. Most of their workers are what? High paid salaried employees. If they have a recession, how many of those people is NVIDIA going to lay off? You think NVIDIA wants to lay off its most key workers? Because what are they going to do? They're going to go to the competition. Same thing with pharmaceuticals. They have a lot of high paid scientists, but man, the last thing they want is for their scientists to go to another firm. So salary workforce, especially high paid, high skilled labor, you don't want to lay them off because then you got to get them back. So that tends to cause a really high fixed cost. Union labor the same way because the unions have these contracts that force you to do things that you may not want to do. There's a time when GM was paying like 300,000 workers just to sit at home because that's what their contract said. They had to cut back workers because they didn't want to produce cars, but they had to keep paying them. Firms with a lot of property, plant, and equipment, that's going to give them a high depreciation cost. It's going to make their net income look very, very volatile. Firms with high CapEx, they have to spend a lot of money on capital expenditures. That's going to make them high fixed costs. Firms like research, like pharmaceuticals with high research and development costs, that can be a high cost. Firms like Nike, and I pronounce it Adidas, but it sounds like they're supposed to be Adidas. How do y'all say it? Y'all say Adidas, right? It's not Adidas, but anyway. But there's just an article in Economist recently about their marketing campaigns and how much they're spending. Why? Because Nike supposedly has some new competitors coming in. Adidas has been really struggling versus Nike, especially when they had one of their key advertisers kind of blow up on them. So, these are firms that it's all about the brand name. When brand name's your biggest asset, you're going to spend a lot on advertising no matter what's going on. You're not going to cut back 10% on advertising just because you have a weak economy, because you got to keep your name out there. So you probably in your economics classes, you talked about elastic demand, inelastic demand. That also has a big impact. If you raise your prices 5% and your volumes fall 10%, that's going to make your net income very volatile. If you have a elastic demand, if you raise your prices 5%, but your volumes only fall 2%, you're in pretty good shape. You're still going to see your revenues go up. So that's an inelastic demand. What's the product with inelastic demand? People are going to buy it no matter what the price. Food, maybe. Gasoline, maybe. Cigarettes is the most common they give. But Yeah, there's certain products, and now cigarettes, that's why the government's like taxing cigarettes. They say it's for health reasons. Why do they really like doing it?
Good people.
Yeah, keep buying it. So yeah, they're almost upset when they raise prices and people buy less because they're trying to raise taxes. So that can have an impact as well. That's not really a operating leverage, but it does add to that volatility. Because if inflation takes off like in 2022 and you can't raise your prices, yeah, you're going to see your net income really get hit because your margins are going to get crushed. So how do you measure this? And the way we're going to do it, I'm going to wait and show you when we do the paper 3-4 example. This is my own idea, but I think it works pretty well. Firms with inelastic demand should have very stable gross margins. Y'all agree with that? Revenue minus cost of goods sold. If your demand is very inelastic, people buy it no matter what the price. If your cost of goods sold goes up, you just raise your prices. So you should have very stable gross margins. Firms with inelastic demand, they should see very volatile gross margins. When their cost of goods sold goes up, they can't raise their prices because it's going to cause them to lose too many customers. So how do you calculate that? Well, pretty simple. You just calculate the standard deviation of the gross margins. If it's high, they probably have elastic demand. If it's low, they probably have inelastic demand. And then firms with fixed costs, high fixed costs, are probably going to see very volatile net margins. And that's exactly what we're going to do. We're going to calculate the standard deviation of the margins of the company you pick, the value in papers 3 and 4. And I'll give you a file that does all that for you. We don't have as much time today, so I'll wait and show it. I'm not even sure what time it is. I never trust. Yeah, okay, that clock's actually right. Okay. All right, but I'll show you this with actual live numbers with the file. I might do it on Wednesday. All right, so step 3 is the easiest of all, and it's your financial leverage. How much debt do you have? And we're going to look at debt to equity, and it's going to be real simple. We're just going to see where does your firm rank on debt to equity versus the S&P 500. Pretty straightforward. It's not a perfect way to do it because we know utilities have high debt, but that's because they have high assets that allows them. So some industry allows, so I probably should calculate this more at the industry level, but we're not going to do that. We're just going to do it in total. But you can get some bonus points on paper 3 if you look at your debt to equity for your company and some key competitors to see how it looks versus competitors, as it has some difference. So Kroger is a good example. Kroger's is a low beta stock, low fixed cost because a lot of hourly workers, and they can raise their prices when coffee prices go up, but they have an enormous amount of debt. So you have that. You can have a low beta, but you might push it up a little bit higher because of their high level of debt. So higher debt makes the firm more volatile, and it's going to make their beta go higher. There's actually a formula for this that we're not going to use, but it's really easy to find, and it's a pretty simple formula. You just do unlevered beta, and the formula will come right up. Investopedia does a good job on this. Y'all probably had this, if you take Catapacum, you'll probably have it in his class, but there it is. Very, very simple formula. So levered beta is your beta as we're doing it for paper 3. It's your actual beta. It's your beta with all your debt. Unlevered, you take that effect of the debt out. So unlevered beta is your levered beta divided by 1 plus 1 minus the tax rate times debt divided by equity. It's essentially your debt to equity, but adjusted for taxes. So unlevered versus levered. You could essentially use this. We're not going to do it in this class, but you do have classes. You will have classes in your undergraduate that will cover this formula. Very, very simple formula, and just shows you how much impact debt has on the risk of the firm and the beta of the firm. And then the last thing you do is history. You could get that from Yahoo Finance, but we're going to actually calculate because Yahoo Finance only gives you the last 5 years. We're going to calculate the last 15, 20, 30 years, just like I did last class. I'll do it again, give you some practice, plus you have a video that shows you how to do it. I say rolling 3-year, you got to take that out. We're doing 5-year because Yahoo Finance changed from 3 to 5. Yahoo Finance used to do 3-year using weekly data. Now they use 5 years using monthly data. What's the correct approach? Who knows? Either is fine. Why they switched, I don't know why they switched. But I love the rolling approach because it lets you see over time how this firm has changed. Huh?
Some like statisticians say that going further back in history gives you a more accurate picture.
Well,
Is that like what-
so should you go back further in history? It kind of depends on what's changed with the firm. So take a firm like Valero. What was Valero 10 years ago? It was Valero and Cornerstone. Does that make a difference? Is there a big difference between Valero and Cornerstone when it comes to beta? Pretty different businesses, aren't they? One's a retailer, the other one's an energy company. And then what did they do with Cornerstone? They spun it off, so it's no longer there. Now, why did they spin it off? They probably spun it off to reduce their beta, reduce their cost of capital, because they didn't think the market was fully understanding that. What happens if Amazon spins off AWS? Does that change the firm? What is AWS? It's a cloud computing tech firm. What is Amazon? A very unprofitable retailer. Why did they not want to spin off AWS? Because then the gig's up. Everybody sees how unprofitable the retail business is. That would be a radical impact. What if Disney spun off ESPN? Would that change it radically? It's hard to say, but yeah, firms can change pretty dramatically. I like to look over time. So we saw with Walmart what changed. They went from a small company to a big company. That has an impact as well. Betas do tend to approach one as firms get bigger. That's just the nature of it, but not for every firm. So, the history to me is insightful. More history may or may not help you too much. It just depends on the firm itself. But I like history because it tells a story. It tells me something about the firm, what's going on. So you're going to go through these 4 steps on your paper 3 and on exam 2. You're going to do in both places to get some practice. So tell me what I just told you. The 4 steps are what? You can do it without looking at their notes. Number 1. Say it again. What? Yeah, what kind of company it is? So what are your 2 choices? Cyclical or defensive. Step 2. Operating leverage. How much fixed cost you have? Step 3. Financial leverage. How much debt you have? And last step, history. All right. So it's a good model. I can say that now confidently that other professors have the same thing. What do you do in most of your finance classes? You bring in the monthly returns for your stock and you do the regression and the slope of that. I don't like that approach because it only gives you one number. You don't see how Walmart changed dramatically over time. You don't see how Valero changed when they kicked out Cornerstone. So I prefer this approach. So what is your discount rate? You're going to see this formula almost every finance class you take. The discount rate for a stock, K of E, K for cost of capital, we can't spell, E for equity, cost of equity capital, risk-free rate. What are we going to use for the risk-free rate? Used to be a huge debate, not any longer, just use the 10-year treasury yield. That's the most common approach, very straightforward. Most people use the 10-year treasury yield, so 4.2%. Why was it a big debate? Well, back in 2020, that number was 0.5%. And you had the big debate of, do we need to adjust that given how low it is? Today, we don't have that issue. The market risk premium, I'm going to give that to you, but you're going to have to calculate it on paper 3, and I'm going to show you how to do it in paper 3. What is the market risk premium? That's the return you need on stocks above the 10-year treasury to induce you to buy stocks in general. Not a particular stock, but that stock in general. So on paper 3, the risk-free rate and the market risk premium, you're going to use that number for any company value. The only thing that's going to change is the beta. All right. Now, when you take Cat Peckham's class, he's going to make an adjustment on this for several things. Probably the most important thing is the size of the firm. Large companies, no adjustments. Small companies, you may increase that 1% or 2% because they're smaller companies. International companies, you increase it as well. All right. So this market risk premium, we generally think that's for large U.S. companies. If it's anything other than a large U.S. company, you might have to make an adjustment. Now, where do you find those adjustments? Well, it's really easy. I've sent his name wrong my whole life. But he has them all out there. You just look them up. Here's his risk premiums by country. So if you want to invest in Abu Dhabi, you need to take that risk premium you have for the US and you need to add an extra 0.72% on top of that. What about Angola? Is that a big adjustment? You're not adding 9%, you're not taking it times 1.09, you're taking it and adding 9. So if the risk premium is 5%, their risk premium is going to be 14%. What about Antigua and Barbuda? Y'all know where that is? Anybody know where that is? Have y'all been there? Where is that? The Caribbean? Yeah, right next to the Virgin Islands, or right next to I can't remember the name of the country, but something risky is going on there. Now, how many publicly traded companies are in that small island in the Caribbean? It only be 2 companies. Who knows what's there? What about Australia? How much do you add? None. They say Australia is the same risk as the United States. What do you think United Kingdom would say then? Probably pretty close to 0. They are adding some. Why is that? Probably because the high level of debt, something, who knows? What about United States? What do you add? Well, there by definition, you don't add any because United States is what you're starting with, all right? What do you think the highest number in here is? Y'all see one? Syria. How many are buying stocks in Syria? What publicly traded companies are surviving in Syria? I can't even imagine there's one. Sudan. I don't know which Sudan this is. South Sudan's not even in there. I don't know what countries there are in Sudan that you could actually invest in. Yeah, I don't. Can you actually buy a stock in Korea? That's not South Korea. Where South Korea is. South Korea is probably much lower. Yeah, South Korea is really, really low, but North Korea is really, really high. But again, can you even buy a stock there? I don't even know how you would even value something in that country. It'd be just ridiculous. That may be the highest one. What about Venezuela? Are y'all buying Venezuela stocks right now? So I don't know what they are, maybe some oil companies or something, but they're all owned by the government now anyway. So it makes some sense. He also shows you the credit ratings. We're going to talk about bonds here pretty soon, the credit of the debt of the country. So he provides this to you. Could you use these numbers? Yeah, these are perfectly reasonable numbers to use. He has his theories. You may not agree with his theory, but if you need a country, so when you take Catapacum's class, don't forget this is out here. If you have a Brazilian company, what do you have to do? You do exactly what you would do with a US company, but you're going to add 4.4% to your market risk premium. Very, very, very simple. What if it's a small company? Then you might add the small cap risk premium. And he'll give you that number as well. It might be 1.5%, 2%, just depends. Smaller companies, we add more risk to. So it's a very, very simple thing. Most people just use Damodaran's numbers. I'm going to make you have to come up with your own, but our approach is going to be really, really similar to his approach. So you'll get a comparable number. So, but I will give you that number kind of. I'm going to get on the exam. I'll give you the number so you can calculate that number, but it's a really straightforward calculation. Essentially what that number is, and we'll see, we're going to use the implied approach, is what return do you expect on stocks minus the 10-year treasury yield? That's called the implied approach. If you think stocks are going to make 8% in the United States and the 10-year treasury is 4.5%, and your risk premium is 3.5%. All right, so you see, we're going to use the implied approach. We'll get into that more when we do paper 3. It's really straightforward. There is a great paper on the market risk premium. I highly recommend you read it. I can't remember. I might put it on our Canvas. If not, I'll put it out there. It's a really old article. It was written by Barclays probably 20 years ago, but it's still the state of the art what people do today, the implied approach. It's a really well-written paper, even though it's dated. All right, so we'll get into that when we value. When I walk through papers 3 and 4, I'm going to go step by step what you need to do. So before we do that, though, we're going to value securities. We're only going to value stocks and bonds. We're going to start with bonds, all right? And then we value stocks, we're going to bring it all together. So when you value any asset, the value of asset is just the present value is future cash flows. For a bond, real straightforward. The bond tells us exactly what the cash flows are. All we have to do is make sure they don't default. A stock, a little trickier. The cash flow might be a dividend. We have to figure out what that dividend is going to be, how fast is it going to grow, how long is it going to last. We usually think infinity. But pretty straightforward. What's the value of gold? What cash flow does gold give you? So you buy a bar of gold, you lock it up in your safe.
No.
You open up the safe, how much cash is sitting there? None. So what's the only cash flow you get from gold?
You sell
When you sell it. That's called what kind of asset? It's called a speculative asset. When your only cash flow is your future sales price, that is a speculative asset. Now you might say, what about living in a house? You buy a house. Is that a speculative asset? What's your cash flow there? It's actually pretty straightforward. What do you get? What cash are you getting when you buy a house and live in it? It's not a cash flow you receive, it's a cash flow you avoid. And what is that cash flow? Rent, right? That's why the Federal Reserve talks about imputed rent for households. They're not paying rent. That's actually the cash flow of a house. You can value a house by using imputed rent and figure out the value of a house. So a house is not a speculative asset. What about Bitcoin? Feels pretty speculative to me. What cash flow does Bitcoin give you? It doesn't pay you a dividend. All the value you get there is what you sell it for later. So some assets have cash flows. What about oil? Well, oil is really a commodity. You know, you can sell it. You know, it's a little bit different because you know it's produced in oil. So, you know, not quite the speculative, but definitely gold, silver, those type of assets tend to be a little more speculative, especially precious metals. But we're going to start off with bonds. With bonds, you should have seen this in 3013, but we'll review it as if you didn't see it. And then we're going to get into duration, some other things that are really, really cool. So a bond, your cash flow on bonds is pretty straightforward because the bond tells you exactly what it is. It has what's called a coupon. A coupon is part of the contract for a bond. It's an annual number, but bonds pay twice a year. So you just memorize that. I don't have to tell you that a treasury pays twice a year. I don't have to tell you that a corporate bond pays twice a year. You just know that's the case. All right. And then we have a bunch of terms for the principal. The principal is that amount you get back at maturity. We usually say it's $1,000, but you know, it's whatever you loaned. It's also known as the face value, the par value, and the maturity value. We have 4 terms that all mean the same thing. So at maturity, that's what you get for a non-amortizing bond. So what's non-amortizing? Well, your mortgage is amortizing. You pay principal and interest, but most bonds, treasuries, corporates, they're non-amortizing. They pay you interest, and at the very end, they pay you principal. All right. So for a non-amortizing bond, a non-callable bond, at maturity, you get your face value back, you get your maturity value back. Very easy forecasts. If you don't expect it to default, you know exactly what cash flow you're going to get over the term of the bond. So it's a really easy forecast to do. What is your discount rate? Well, it's going to be the risk-free rate plus a spread. We talked about spread on exam 1. So the spread is what you need over the benchmark, the risk-free rate, to compensate you for the risk of that bond. The risk-free rate is going to be the treasury. What is the yield on the treasury for a bond with that has the same maturity as your bond? So if you're looking at a 5-year corporate bond, you'll use a 5-year treasury. You know, 10-year corporate bond, you use a 10-year treasury. Very, very straightforward. Corporate bond spreads reflect the probability of default and what kind of recovery you might get if they do default. So AAA are going to have what? Wide spreads or narrow spreads? Yeah, very, very narrow spreads. Triple B kind of wide, triple C, really wide spreads. All right, so I will give you the table that shows all the spreads. We'll get some practice with that. You'll see how we're going to do that. So then you just discount the cash flows. Very straightforward. We got enough time to do at least one bond here, so let's do it. You should have done this before, but I'm going to show you how I did on the exam, and then I'll show you how the fact exam does it. The fact exam, forgive me, Dr. Baynot, but it does it wrong, because how many coupons does the fact exam assume? One. That doesn't make sense. One coupon a year is not correct. But that's what the fact exam does. So you're kind of stuck. But we'll do that. We'll practice. I'll show you the fact exam. All right, we're going to do one because I'm going to show you some tricks that are really, really cool. So let's say we have a 20-year Treasury bond issued 15 years ago. All right, so what's the maturity? This is a 20-year bond, 15-year bond, 5-year bond. What is this bond? And from the market standpoint, it's a 5-year bond, right? We don't care that this is, well, it's going to influence our coupon, definitely, but maturity is 5. All the market cares is how many years are left, okay? Now, what is the coupon? Let's go find the coupon. So Treasury yield curve. Hopefully it's this first one. We said 15 years ago. 15 years ago would be 2009. Not a really great year, but we're coming out of the recession there. 2009. So it was a 20-year bond. So the coupon was somewhere around 3.5%. Right. And the treasuries, when they issue at par. So they're issuing whatever the current rate is. So 3.5% is our coupon. Now we're going to do a 5-year bond, right? Because now it's 5 years left. What's the current yield on this bond? What are 5-year bonds paying? We're not going to use the current 20-year bond, right? Because this is not a 20-year bond. This is a 5-year bond. So we go back. What's the current discount rate on a 5-year bond? 4.35. Let's just use 4.4. So this is a 5-year bond that's paying 3.5%. You could get a 5-year bond somewhere else that's this risk-free that's paid 4.4%. Do you like this bond? Yeah. You like having a bond that's paying 3.5% when you could get 4.4% somewhere else? If you try to get someone to buy this bond from you, what would you have to do for it? You'd have to discount it, right? Okay. Now, this bond pays twice a year. So our discount rate is also known as the effective yield. Why? Because we have to adjust for the fact that it pays twice a year. So really easy formula. The effective yield, it's just 1 plus the yield divided by 2 raised to the 2 minus 1. Oops. Not divided by S, but divided by 2. Because it pays interest twice a year, you divide yield by 2, square it. So essentially you're compounding an extra period. What if this was a bank CD that paid monthly? What would you do? You divide by 12, raise it to the 12. That's what the APY is you see on CDs. All right. But for corporates and treasuries, you divide by 2 and raise it to 2. And you have to get something higher than this number. So 1 plus that divided by 2, raised to the second, minus 1, you're going to get something slightly higher. Right. So what is the value of this bond? So I'm going to give you 4 approaches. You can use all 4 of them on the exam. You don't have to, but you have to do one of them. The last one I'm going to show you. So the first one is the guess. So remember on exam 1, we said minus duration times the change in yield equals the percentage change in the bond price. I'm gonna guess the duration of this bond. It's easy on exam too, because I give you a 2-year bond. A 2-year bond is kind of a duration of like 1.8 years. 5-year bond is a little tricky. I'm gonna guess 4.6. So if we take minus 4.6 times the change in yield, what did yields do? So the current yield is 4.4%. It started off at 3.5%. That's going to be the percentage change we're going to guess. So we're going to do minus 4.6 times. I'm not using the effective yield. I'm using the actual rate. I'm guessing this bond is going to sell at a 4% discount. So $1,000 times 1 minus 4%. My bond price guess is $958.60. Right? That all depends on how good my duration guess was. Now, the second approach, so that's approach 1. You don't have to do that on exam, but it's really good that you can. The second approach is the Bill Gates cheat. How do you do the Bill Gates cheat? Equal, you can do this on the fact exam, equal minus PV. What is my rate? 0.044 divided by 2. Why divided by 2? Because it pays twice a year. Comma, what's my number of periods? It's a 5-year bond, so I heard someone say it. 10, right? Yeah, I've done this before. What's my payment? The coupon's 3.5%. So it's going to pay $35 a year, but how much every 6 months? $1,750. And what's my future value? What's the maturity value? Because in dollars, what does Bill Gates say this value is? $960. How good was my guess? Pretty decent guess, right? The third approach is crazy sweet. I think you should be able to do this approach because it shows you really understand the bond. And have y'all seen the present value interest factor table? This is the formula for that. So let me just, don't write it down, just kind of take it in. You should be taking notes, but don't write this down. Let's say this bond were to pay $17.50 for all of eternity. How much would $17.50 for all of eternity be worth? Well, you take the cash flow divided by the discount rate, and that's the value. If someone were to pay you $17.50 for eternity, that would be worth $795. Now, does this bond pay you $17.50 for all of eternity? No. But it does give you $1,000, but the $17.50, I never get this right the first time. We'll see. Maybe this will be the first time. In 5 years, we can get $1,000 and the $17.50 stocks for all of eternity. So we want to add $1,000 in 5 years, and we want to subtract $17.50 for infinity for 5 years. So what do we discount that at? 1 plus 0.044 divided by 2 raised to the what? The 10. I'm scared to hit enter, but we can try. How close does that look? Did it work? What is your present value interest factor of an annuity doing? It's doing exactly this, but with $1 instead of that. That's what that present value annuity is doing. It's saying, hey, what's the present value of this cash flow for infinity? Then subtract the part that's not in the infinity part. So that's what that table is actually doing. That's the formula. So we take infinity minus the infinity, but the infinity is 5 years out. So that's what it does. Looks pretty close. And then the required is the table. All right. The table approach you have to do, and this is going to be written. You don't get to do in Excel. I wish we could do this exam in Excel. We could get really crazy there. But here you have time, you have your cash flow, you have your discount factor, you have your discounted cash flow, Time is you get a cash flow in 6 months, you get another cash flow in a year, all the way out to 5 years. What's your cash flow? $1,000 times 3.5% divided by 2. Everybody see that? Your cash flow is your $1,000 face times your 3.5% coupon divided by 2. Y'all remember doing this in 3013? Except for what? When does that change? When you not get $17 at the very end. There you get $1,000. How hard was that forecast to do? Pretty easy, right? A lot easier than forecasting the cash flow for an NVIDIA stock, isn't it? What's your discount factor? Pretty simple. 1 divided by 1 plus, here you use the effective yield. Raise the time. Here's your discount factor. Lock in. Should get something around 0.98, 0.99, all the way down. What's your discounted cash flow? You just multiply across. And so the table value is just the sum. We're going to do several of these in class. Your sum of your discounted cash flows. 960. The last thing, we got time. Don't make me leaving noises because this is the coolest part. What's the duration? Everybody remember the definition of duration? The weighted average time maturity using the discounted cash flows as weights. The cash flow is, first cash flow is half a year out times its present value divided by the price. What is the duration for this bond? $4.62. What did I guess? 4.6. See how close I got. So there's duration. We'll do it again so you get some practice. You don't have to do this on the exam, but isn't that cool how easy that is? You just take the time times the discounted cash flow divided by the price, add that up, and that's your duration. All right, I'll stop there. I want to do a couple of the beta things we didn't get in last class just because I wanted to make sure just the files are up to date. We'll do some more bond valuation, which I think is really exciting. I'm reading a paper written by the former head of fixed income at UTSA, and I'm halfway through it. It's really overly specific for our purpose or for bond valuation, but you can get really quantitative in this. And if we have time, we'll do some stock valuation, although that's a little bit questionable. So one thing I love to show on beta, just to make sure you really understand the concept of beta. So for me, beta is a term every finance major should just, you should be able to top of your head, just be to write 15 pages, just off without even no textbook or anything, because it's such a hugely important topic. But in my interviewing, not just undergraduate students, but even graduate students from Yale, you ask them about beta, and it's amazing the lack of understanding of beta. There's something going wrong with the way we're teaching it. So I'll try this approach. So what I did here is I brought in 9 stocks from all different industries: Apple, Ford, Bank of America, 3M, General Dynamics, AT&T, CVS, Walmart, and Exxon. I brought in their weekly returns. And here's their average return. Apple has the highest average return. Here, why am I multiplying by 52? Because it's 52 weeks in a year, so that's their annualized arithmetic return. Apple has the highest return, so there's no way to get a higher return than putting 100% of your money in Apple. But our question is, what happens when you diversify this portfolio? And so when you diversify this portfolio, so here's the standard deviation of each one of these stocks. Apple actually also has the highest standard deviation, but you see all the way down the line, Exxon has about the lowest return, or one of the lowest returns, but a very, very low risk. And so what I do here, if you put all your money in Apple, this would have been your return in risk. If you put 50% of your money in Apple and 50% of your money in Ford, your return would have dropped down to 2155, which is pretty obvious because Ford has a lower return. But what happened to your risk? So your risk was not half the risk of Apple plus half the risk of Ford. that would have been 40%. Instead, your risk was only 32%, much, much, much lower. And why is that? Well, it's because the correlation between Ford and Apple is not one. If the correlation between Apple and Ford's return was one, you would get the exact same standard deviation as the average of the two. So this is what the diversification benefit is. If you put your money in Apple, Ford, and Bank of America, three very different firms, the return drops only because Bank of America had a lower return, but the average of the standard deviation of these companies, Bill Gates, it's over 40%, but your actual risk is now below 30%. That's the effect of diversification. And that's the effect of unsystematic risk. And as you just go across, you'll notice that your average risk is much higher than the risk of the portfolio. So you put more and more stocks in there. And so your return's 15%, your risk is 18, but the average risk of those 9 stocks is 30%. So just having 9 stocks in your portfolio reduces your risk almost in half by doing nothing more than diversify your portfolio. That's the unsystematic risk. How much unsystematic risk do they have? Well, here's the R squared. That's the percentage of the return. So the R squared of the stock's return to the S&P 500, that's the percentage of their risk that is systematic. So 21% of Apple's risk is systematic. How much is unsystematic? 79%. That means when you put Apple in a portfolio, 79% of risk just disappears. Ford has 35%, Bank of America 38%. 3M has a very high systematic risk for some reason. But you see all of the stocks, the majority of the risk is unsystematic, which means the majority of the risk disappears when you diversify. It's really, really powerful stuff. You might be upset that your return dropped so much. If you knew 30 years ago that Apple would have the highest return, and stick all your money in Apple. That's pretty obvious. But we're talking about risk. What's the key to risk? You don't know the future. So obviously, if you don't care about standard deviation, you don't care about anything. If you know Apple has the highest return, stick all your money in Apple. That's really simple. That's really easy. But we're talking about risk versus return. Do you think Apple's going to have the highest return going forward? Maybe, maybe not. Who knows? But you absolutely know if you put your money, spread them on these 9 stocks, your risk will drop dramatically. How many stocks do you need so that systematic risk the unsystematic risk goes to 0? Somewhere around 20 stocks, you completely eliminate unsystematic risk, assuming they're all in different industries. If they're all in the same industry, then yeah, you're going to have more stocks than that. But this is a pretty good mix of stocks. I don't know if I have any consumer discretionary in there. I guess Ford falls in that category, but pretty good mix of stocks. So that's what beta's trying to tell you is, as you add these companies, your unsystematic risk disappears. So you only have to focus on the systematic, which is generally 20 to 40% of a stock's risk. 60 to 80% of the risk is unsystematic and disappears. And here's the betas of the companies. Bank of America has the highest beta. That's probably because I have 2008 in here, and 2008 had a huge impact on bank stocks betas. Who has the lowest beta? AT&T, that makes sense. Telecom would have a low beta. CVS, healthcare, Walmart, Exxon, really low betas. Ford, Apple, Bank of America have higher betas.
So last class you mentioned that private equity, they don't really do the same method.
Well,
do systematic.
Yeah, private equity, you have all your money in one stock, so you care about standard deviation.
So they don't do they don't put a whole fund together.
Well, they can have different companies, so they have some diversification, but it's not the same. It's pretty concentrated, and there's usually most private equity firms are concentrated in one industry.
So does beta matter?
I doubt they look at beta. And usually their returns, they're shooting for 30-40% returns, not 7-8% returns you want on the stock market. Yeah, they have much higher returns.
So what do they diversify on? Like, what's their method for that?
They don't really talk about diversifying because, as I talk in my risk class, there's a debate between familiarity and diversification. The more diversified, the less familiar you are with the companies. Private equity, they're really concentrated because they understand that industry. So take the alum, I keep forgetting his name, but up in Colorado, they started a private equity firm that does nothing but cannabis. All right, that's pretty wild, right? But they've got cannabis companies. That's a pretty concentrated risk, right? They're going to need 30, 40, 50% returns to cover their risk because they're so concentrated. Now, when USAA bought private equity, we might have bought private equity from 10 different firms in different industries. So we were a little bit diversified, but it's a very different asset class. Yeah. They don't talk. I would be really surprised if a private equity firm ever mentioned beta. It just wouldn't be part of what they do. Right. The other thing we talked about was the impact of financial and operational leverage. And so I gave you this file. I forget what I updated it to. Let's see. 2022. So I haven't updated 2023 yet, mainly because some firms 2023 is like June 2023 through May 2024. So it gives me a lot of NAs. So I just went through 2022. But all you have to do is go find your company. So let's go find the company. Let's do Apple, line 11. So let's do Apple. So you look at Apple's, you gotta be real careful on paper 3. This is not their gross margin. Apple would die with a gross margin of 5.2%. This is the standard deviation of the gross margin. Their gross margins are more volatile than the gross margins of the S&P 500, which implies a more operational leverage than a typical firm. On their net margin, they're much more volatile than a typical stock. They're at 10%, and typical stock standard deviation net margin is 7.59.
What is exactly the gross margin of a standard deviation mean?
This is the standard deviation of their gross margin. So here's their gross margin over here. All I did is I just did equal STDEVP of their gross margin. It's just the standard deviation of their gross margin. Higher to me implies more operating leverage, lower implies less operating leverage.
So like you would use standard, would you use like the sample estimation?
I always use P just because we're just looking, we don't have to be, it wouldn't matter in the rankings here. So it doesn't really matter here. And we're not doing statistics that we need standard deviation. I'm just doing this as a measure of their relative. So all of these are doing the population. All right, so Apple's 5.2 on their net margin, they're more volatile. So you could apply, you could say, hey, they must have more operating leverage than the typical firm. So we need to add a little bit more to their beta to account for that. On debt to equity, this is their debt to equity. Now, Apple is grossly misstated. You may know why that number is wrong. What do we know about Apple? Looks like they have a lot of debt, doesn't it? Does Apple really have a lot of debt? It looks like it, right? They got $15 billion in debt plus another 15. So they got $30 billion in debt. But what else do they have? They got $61 billion in cash. So there's something called gross debt and net debt. I'm doing gross debt, but net debt is debt minus cash. If I did that, they'd actually have a negative number. I don't like getting negative numbers, so I don't do that. So a few of you firms, like if you do Microsoft or Apple firms, Microsoft's another good example. Microsoft, one of the few AAA companies left. Look at that cash, 184 billion. Don't you wish you had $184 billion in cash sitting around? You got to figure out something to do with it. They do have debt, but who cares about their debt? I mean, who cares they have debt? I mean, yeah, $50 billion in debt, but they got $200 billion in cash. Why don't they just pay that off? Well, most of these firms have debt for tax reasons, not because they need cash. They just have debt because they need they want to pay dividends and they don't want to pay tax. So you have to be careful. I was tempted to use net debt, but negative numbers really mess things up here. So just be aware of that. So you might want, if you pick a company like an Apple or Microsoft, you may want to look and see what their cash is. If they have a lot of cash, you want to somewhat downplay this number. So if I were doing Apple for this, I would essentially say, ignore that number. Their cash is greater than their debt. Obviously, they have very low debt. That's going to bring their beta down quite a bit. And there's a few companies like that, especially these cash cow large tech firms.
So you said that you gave us that document?
Yeah, it's on Canvas.
All right, I'm looking at it.
All right, let me find another company. Let's try Tesla. So you find your company, 2694 is the row, 2694. So there's Tesla. Tesla has very, very low debt. So that's probably going to bring your beta down. But their gross margins are incredibly high. I'm sorry, I said it exactly wrong. Their standard deviation or gross margin is extremely high, and even more so, their standard deviation or net margin is like a ridiculous number. But what would we notice with Tesla about their gross margins? Very volatile, very volatile, very volatile. And then what? Last few years, much more stable. So some of that is they started up with really radical numbers. So there's another thing to be careful of. It may be a radical number because they had 2 or 3 just crazy years, which you may want to discount that. Some of these are just, I don't know how you have a negative gross margin. That doesn't make a lot of sense. It's like you're giving your cars away or something. It doesn't make sense. But so some firms, the numbers can be pretty tough. You look at a Tyson's Food, very, very different firm. Pretty average debt, but very, very stable margins. Because if beef prices go up, they can charge more. Consumers are used to, prices going up. Now, one of the most stable firms in the entire S&P 500 is Costco. 653, line 653. Pretty average debt, but look at their margin standard deviation. Extremely predictable margins. Very, very, very stable margins. Very predictable firm. And you can actually see it in the numbers. You look at their gross margins, 12, 12 and a half, 12 and a half, just very predictable. If you were forecasting the firm, Costco would be a really easy firm to forecast. They're very, very stable in their margins. Their net margins are just ridiculously stable at 3% over and over and over again. It's an incredible firm. I love this firm. Their CEO says their goal is to make as little money as possible. You think, well, that's a terrible thing to say, but their goal is not margin. Their goal is turnover. They want to, if they can save money, they're passing it on to their customer, and then they're just going to sell more. And they're strict about that. And their stockholders have complained, why can't you let this margin go a little higher? They have been creeping up a little bit here. That's probably more due to their membership fee, which I think they increased. Any of y'all a member of Costco? Have they increased their fee here recently? They do it kind of in jumps every 5 years, and that has a pretty big impact on their margins.
I know they used to be like, I think when they first started out, when they first public, like $45.
A year or a month?
I think it was a year.
Yeah, I was a member like for 3 years and bought everything I could and then canceled my membership. It's an incredibly impressive firm. It's also a ridiculously expensive stock. So I don't, if their stock would come down, I would buy it because I love the firm. I was listening to a business breakdown of another firm I didn't know was public, which is the language firm. I just forgot the name of it. What was it?
Duolingo.
Yeah, Duolingo. Man, it's an impressive firm. Yeah, just amazing. So that's one I might look at it doesn't have a lot of data, but boy, if I was doing papers 3 and 4, I would probably do Duolingo just because I'm really curious. How can a firm like that already be profitable? It's really impressive firm, but probably in a very expensive firm, but I love it. It's got this wonderful social mission, what they're trying to accomplish. It's really, really impressive. Costco is one of those firms that just, they know who they are. They're incredibly valuable to their customers and to our economy, but the stock market already recognizes that. So you'll be using this file in your paper 3 to try to help understand what your beta needs to be. Does this firm have high operating leverage? You see that in the standard deviation of the margins. Do they have high debt? You see that in their debt to equity. So it's a pretty easy chart to use. You just, I mean, a file to use, you just put this into your paper. All right, that's it for beta. So let's do some more bond valuations. So last class we did really fast. We did a treasury. All right, let's do another treasury, just get some practice here. On the exam, you're going to get a 2-year bond because you have to do it by hand, and I can't have you do multiple years. But so someone was asking, why am I making you do the table? It's because I want you to see what the calculator is doing. It's just extremely important to me that you can visualize what the calculations are. That you're not black boxing, just sticking stuff into a formula. You got to picture what these formulas are doing. Plus, you can't calculate duration if you don't do this. You have to have all of this data. So to do duration, you have to do it. So let's do a 30-year treasury issued 20 years ago. All right. So what kind of bond is this? It's a 10-year bond. Coupon. So 20 years ago, let's see if we can find the coupon 20 years ago. Should be easy. So 20 years ago, the 30-year, you can barely see the 30-year. We'll just have to go here, 497. The current yield. I don't know what this thing here is, and I don't know how to get rid of it, but where is the 30-year? 451. So is this a discount bond or a premium bond? It's paying you 497, and the best you could get anywhere else right now is 451. It's gonna be a premium. All right, we have to adjust it. You just take 1 plus the current yield divided by 2 raised to the second minus 1. I'll just use this formula over and over again in any other problems. So 1 plus 4.51 divided by 2 raised to 2 minus 1. It has to come out to a higher number. It can't be a lower number than the current yield. All right. So let's do a guess on this. Okay, 10 years. So remember, duration is time to maturity, but you include all the coupons. So it's going to be shorter than 10 years. This is where I'm going to really guess way off. What my trouble is, so duration falls as interest rates rise. 451's kind of in the middle range there. So, oh man, I'll be way off. I'm gonna guess 9.3 years. So remember the formula: minus duration times the change in yield. So if I do minus 9.3 times the change in yield, well, the yield today is 451. it was 97, so interest rates have fallen, so the bond prices can be above $1,000. So if we take $1,000 times 1 plus that, we get that we think the bond price is 1042.78. Right? That's how you can use that form. That's a guess. You don't have to do that on exam, but that's what you actually want to do in interviews in your mind. If interest rates are up or down, just think a 10-year treasury has a duration somewhere between 9.9 and 9.6 years. It really depends. When interest rates are really low, like in 2020, I mean, duration would be like 9.8 years. It can be pretty close to 10 because there's just almost no discounting there. And then we'll do Bill Gates. What does Bill Gates say? Y'all remember this one? PV. What's the rate here? Well, it's 251, but you have to divide. I don't. You have to divide by 2. What's the number of periods? 20, right? 10 years. Y'all should be able to do this on your calculator. If you try it on your calculator, so you don't get Excel on the exam, but you do get Excel on the fact exam. What's the payment here? It's going to be $1,000 times the coupon, and then what else do I have to do? One last adjustment. Divide by 2, right? Because it pays twice a year. Then what's the future value? What's the maturity value? $1,000. All right, so I wasn't too far off, but kind of in the ballpark. Then you got the crazy sweet. I doubt any of y'all can do this on the exam, but boy, I'd be impressed if you did. So here you say, wow, you know what? I'm going to get this cash flow, 2845. And let's say I get that for all of eternity. So I divide that by the yield divided by 2. So there's that coupon for all of eternity. But we know we're not going to get that for all of eternity, but we are going to get $1,000 back, but we have to subtract that 1,000 times B3 divided by 2 divided by E4 divided by 2. Now, if I hit enter here, I'm just going to get $1,000. So obviously I did something wrong. So let's figure out what I did wrong. Yeah, I don't know what I did wrong. So there's something it's amazing. Last class I actually got it correct. Yeah, I think we need one more parentheses here. Yeah, there's something wrong, but we'll see here in a second. So we're going to, oh, I did minus. That's probably part of it. There we go. All right, so here's the coupon for all of infinity. We're going to get that, plus we get our $1,000 back, but then we don't get the coupon for all of infinity, but starting in 20 periods from now. So we're going to divide this whole thing by 1 plus the discount rate divided by 2 raised to the what? How many periods are there? 20. Y'all think I got it right? I think I'm like 60%. How does that look? All right, so I got it. It's a lot of parentheses, so that's kind of a problem. But you understand what we're doing there. I mean, it's exactly what your present value interest factor is doing other than the $1,000 in there. But the required one is the table. So you got to do the table. Anybody remember the columns without looking? Time. Your cash flow. What's next? Discount factor. Discounted cash flow. So time, we get a coupon in half a year, another one in a year. We do that all the way out for 10 years. So on the exam, you'll only go out 2 years. What's our cash flow? Our cash flow is going to be $1,000 times our coupon divided by 2. So 2485. We'll get that. Every 6 months, except for the very end, we'll get our $1,000 back. All right, everybody know how to get the cash flow? Very, very straightforward. Now, the guy who sent me his paper, he was arguing, I've seen this argument before. We're going to use one discount factor for this whole thing. What he's arguing is you should use a different discount rate for every one of those cash flows. You should use a 6-month treasury for the 6-month cash flow, the 1-year treasury for the 1-year cash flow, the 18-month. That's more accurate, but boy, is that a lot of work. So we're not going to do that. So we're going to take 1 plus our discount factor. Here you have to use, this is the only place you use the effective yield. You don't have to divide by 2. Raise it to the time. You'll get something slightly below 1. So 1 divided 1 plus the effective yield. No divide by 2, raise to the time. Why don't we divide by 2? Because we're raising it to the precise time here, 0.5. We copy that down. And then our discounted cash flows, we just multiply across. What's $24.85 that we're receiving 6 months? What is that worth today? And it's worth $24.30 all the way down. So when we sum that, we get 1036.70. So either my duration is too high, or what else could be going on? Yeah, remember on DC cuts I, what else is there besides the D that influences by interest rates? Convexity, right? It could have positive convexity, but here it'd be too much. So I'm too high. So what is the duration? You don't have to do duration on the exam, but boy, it's such an easy thing to do. You just take time times the cash flow divided by the total cash flow, because it's the weighted average time to maturity. And so your duration, let's see how close, I'm almost embarrassed to see, but we'll see how close I got. The actual duration, my word, how could it be that low? I've had so much trouble with duration because interest rates are back high and I'm so used to them being low. So if we do that, get them much closer, right? It's really in the ballpark there. So, wow, that's really amazing, 8.04. As interest rates rise, what's the duration? If interest rates were to be 10%, the duration drops down to 750. If interest rates were 1%, the duration, I don't know why I'm not getting higher, so something strange going on. But anyway, so duration 804. Here's my prices. The guess is still really close. So you got to do the table on the exam, but you don't have to do duration. Could we calculate convexity here? We could, but boy, would it be a long formula.
So for the test, we have to do the table, we can't choose any other method.
You have to show me the table. You can do another method. If you want to plug this into your calculator to double check, you can do that. But I want to see the table. I want to see that you understand what a bond is.
Okay.
Could you show that formula again and have
Which formula?
the Bill Gates and also the duration?
Yeah, it's going to look different. It's going to look different in your on your calculator, but it should be. I mean, who's tried it on their calculator? My trouble with the calculator is you have to keep hitting enter, which is just bizarre to me. So it's strange. Are you getting the same answer in your calculator, Stephen?
Oh,
Have you tried this problem on your calculator? I mean, it works in Excel. It's pretty easy in Excel, but on the fact exam, it's real simple, except for on the fact exam, for some reason, they assume the bond pays interest once a year. Then you take all those divide by 2s out. But on the fact exam, yeah, it's real straightforward, real simple. I mean, I can show you a fact problem. Well, y'all have already done the fact exam, right? So you wouldn't be in here. Y'all passed the fact.
Yeah. So I got mine coming up.
Well, I can show you a fact exam question. If I can find. All right, let me do this real quick.
Yeah, I got that one.
So let's look at these fact questions. Your friend Barbara, I don't want to put names here. I guess I want to make it real life. She has a bond she wants to sell you. The bond matures in 10 years. Has a face value of 1,000. That's just kind of the comment we use. The coupon is 6% paid annually. All right. That's, I don't know where she bought this bond, but that's a bizarre bond. But anyway, she's got this bond that pays annually. If you know that the yield maturity is 8% on similar bonds, that's that current yield. They say yield to maturity, current yield are almost the same concept. What's the maximum price we're willing to pay for this bond? So on the fact exam, you just do equal minus PV, and then what's the first thing? What's the rate? 8%. What's the number of periods? Here it's 10, it's not 20, right? Because it only pays once a year. What's the payment? What's the coupon? 6%. So 1,000 times 6%, you don't divide it by 2, right? It's annually. So what's your coupon? 60. And then what's your face future value? $1,000. You see that number up there anywhere? 865.80. It's a really simple question, isn't it? You should complain that she's only getting interest once a year, and this is not a realistic bond. Why they do that, I don't know. This, huh?
Also, what would it be realistically then?
Well, if you did it twice, you're going to get a slightly different answer, but not radically different. So 864.10 instead of 865.80, but it's not going to be a radically different answer. Now, the second one, they do this problem, and it's a little bizarre because they don't give you the exact answer. So what I would do with a problem like this is I would do all 4 scenarios and just see which one's the closest. So a coupon which pays interest of $60 annually, has a par value of 1,000 and matures in 5 years, is selling today at 915.48. So you're going to do equal minus PV. And the rate is maybe it's 6%. We'll try that first. Your number of periods is 5, should be 10, but it's only 5. Selling today at 915, you don't care about that. That's what we're actually calculating here. The yield to mature in those bond is approximately, we tried 6%. So what's the payment? It's $60. The maturity value is 1,000. So if I were doing this, I would just do each scenario. 6, 7, 8, 9. Which of those is closest? The 8%. Now there is a way that you can do a simple a formula, but if I'm in fact and I got Excel, I'm going to do it like that because that's a lot faster than that massive formula you have to plug in. That's well, if you do, you could, yeah, you could in Excel, you could, but I tend to be lazy. In fact, I'd probably do that and just do it as a formula because you can do that a lot faster. But anyway, so those are the 2 bond questions that they have on the exam, and the exam is probably going to have those questions almost exactly like that. So the fact that you get to do it in Excel, the PV function would work really, really well. All right, so we've done a couple of bonds here. So now let's try a corporate bond. So a corporate bond's a little trickier because you need a different discount rate. So let's look at the class notes and let's understand. We've already covered that. So when you're doing corporate bonds, it has a spread. and the spread's related to its rating and to its term. What happens to spreads as the rating falls? The right widens. What happens to the spread as time increases? Also widen. You may know what this is called across. So that's called the term structure of credit spreads. It makes sense if you're going to loan someone money for a year, you're not as worried than if you loan them money for 10 years. So you demand a higher spread for 10 years. So that's the term structure of credit spreads, pretty common. And then the term structure here is just, you know, the higher risk of each bond going down. You notice all the single A's have very, very similar. Well, it does kind of start jumping when you get down into single A's, but very similar yields, spreads. And then when you jump from triple B to triple B minus, a big jump in spreads. Here's spreads over time. I think I've shown y'all this before, but triple A, the average spread has been 30 basis points. Not much compensation. In 2021, they got down to 12 basis points, almost nothing. You almost could not tell a difference between a Treasury and a AAA. But how many AAAs are there? There's only 2 left. So this is Johnson & Johnson and Microsoft. So it's only 2 companies. Double A, you get 83 basis points. Single A, you get 121. Triple B, 178. And high yield, almost 5%. The 2021 low was just absolutely ridiculous. November 08, which was the max. I mean, it's amazing. Triple A's in 08, you're paying 157, which is what essentially you're getting the same spread as a triple B bond or a triple A bond. It was crazy back then. You should have been buying bonds in November of 2008 because you would have had a huge return in 2009. Look at double A, 439 bips. And high yield, I was buying high yield in November of 08. 18% over risk-free rate. That's like a stock on steroids. That was just an incredible return. And yeah, it was just the time to buy high yield. I would not be buying high yield right now. 394 basis points. It's like, why would I waste my time on something that has a high probability of default? And what's the probability of default? This is pretty old stuff, but it's pretty useful. Here's the default rates over 10 years. So for AAA, like Diego has to do a problem like this in my risk class. We did it last class. 78 basis points over 10 years. You divide that by 10, you get about 8 basis points. So with AAA bonds to cover for default risk, you need about 8 basis points in spread. What was the spread? It's more like 30. You need 8, and it's paying you 30. So you're getting well compensated for that credit risk. AAA, you're getting paid 83. But that 83 covers you for 10 years worth. You're getting an 83 every year, but that 83 almost covers you default risk for the whole 10 years. So you need about 9 basis points, and it's paying you 83 basis points. So it's paying you a pretty good coverage. I have this updated somewhere, so, but it does have the 2008 in there. Speculative grade, look at that, about 24%, about a fourth of double B below, and triple C, over half of them are going to default next 10 years. But it also means half of them won't default next 10 years. If you can find the ones that don't default, you're going to make a fortune because they're going to double in price. So you got to find which one those are. But this is a really good table. Standard & Poor's and Moody's have stopped issuing these statements on the internet. You have to pay a big fee to get them, unfortunately. So it's hard to get. And they're the only ones that really publish this at all. So you just can't get it. All right. So let's do a corporate bond. We'll use this table. So let's say this thing is a 10-year bond issued 5 years ago. It was rated AA. Now it is rated triple B. So what is my time here?
5 years.
It's a 5-year bond. What's its rating? Triple B. You don't care that it was rated AA, other that's going to affect your coupon. All right. The coupon. So it was a 10-year bond 10 years ago, 5 years ago. So 10-year bond yields were 2.5%. And what's the spread? I can go look it up. I guess we could look it up. Well, I don't want to load up the file. So we'll just use what the spread, we'll just assume they're about the same. So it was a AA bond and it was a 10-year bond. So let's say the spread was 100 basis points, somewhere close to here. So its coupon was 3.5%. So it's going to be 5 years ago, what was the 10-year treasury and what was the 10-year spread on a AA bond? All right. Now today, the risk-free rate, what risk-free rate do we want? The 10-year or the 5-year? It's a 5-year bond, right? So we want the 5-year yield. The 5-year yield is 4.35. What's the spread? Someone tell me the spread. I heard it. Say it loud. 104. How do you convert basis points into a percent? Divide by, anybody remember? 10,000. All right, so their spread went from about 100 to 104. Why didn't it go up more when they were downgraded? Well, because we went from 10 years to 5 years. All right, so that term structure, if we're still a 10-year bond, it'd be 158. But you see how much the fact that time is reduced reduces that spread. So what's my discount rate? You just add those two together. At this point, the problem is exactly like the treasuries. Nothing changes. We figure out the effective yield. Anybody remember that? Someone give me that formula.
1 plus the
You can say the number. 1 plus what? What?
3.5.
Not 3.5, not 3.5, but by a rate. Which rate? The current, what's the current yield? 5.39, right? And then, or you keep going, and then what do you do? Divide by 2.
The power 2 minus 1.
Power 2 minus 1. If I get 527, is that good? It's got to be higher. This is also known as the APY. Right. So at that point, so we can do the guess. I'm going to guess the duration. Let's say 4.2. So you do minus 4.2 times the yield today is 546. It was 350. So the price has fallen 8%. So you take $1,000 plus 1 plus that. Oops, what did I do? Times. So I'm thinking the bond's gonna be worth somewhere around 917. Who knows how close I got, but so we'll do Bill Gates equal minus PV. So the rate is, well, we'll just reference it, 539 divided by 2. My number, what's my number of periods? 10. What's my payment? 3.5% times 1,000. Divide by 2. And my future value, $1,000. All right, this will be embarrassing. Not too bad. I mean, if you're in an interview and you got that close, they'd probably be impressed, right? On top of your head, you could do the math. My boss did this like all the time because he always likes showing off. Oh yeah, that bond's about X, and he was doing that formula in his head. He was always doing it. All right, let's do sweet. I won't call it crazy sweet anymore because y'all got it down now. So we'll take the 1,000 times the coupon divided by 2. We'll assume we'll get that for all of eternity. So you divide it by your discount rate divided by 2. So the coupon for all of eternity is 649.35. But we're not going to get that, Rex. You can get $1,000 minus that. And watch how lazy I am. We're going to divide all of that by 1 plus my discount rate divided by 2 raised to the what? To the 10. You think I have a shot? You don't see any errors? How many? I think it's going to be right. No confidence in the professor. Y'all should have. I was going to give you $10,000 if you bet it. But, all right, so pretty close. But I want you to be able to visualize it and be able to calculate duration. So we got time, cash flow, discount factor, discounted cash flow, and then we'll do duration. So here, 0.5. You go out 5 years. Cash flow is $1,000 times 3.5% divided by 2, 1,750. And then what do? One last step. Add 1,000 in the last year. Discount factor. Anybody remember that formula?
1 divided by 1 plus the effective rate.
Yep.
Divided by 5. That's
Is that right? Yeah, so effective yield, make sure you use effective yield. Don't do the divide by 2 here. All right, the only time you do the divide by 2 at the table is when you're calculating the effective yield, but here you don't need to. If you're using effective yield, it's already got that adjustment in it. DCF, just multiply across. Now, if you did all 4 of them on the exam and this is what you got, how confident are you that you did it right? I'd be pretty confident. It'd be hard for you to get that close on those 4 of those and you did something wrong. I don't even know if that would even be possible. You'd have to have some really, maybe you're typing the interest rate wrong every single time or something. You would have to really get it wrong. Anybody remember the formula for duration? It's the weighted average time to maturity using the discounted cash flows as the weight. Where's time in here? Right there. There's my weights, right? So what would the formula be? 0.5 times the cash flow weight, which is each discounted cash flow divided by the sum. All right, let's see how close I was. Again, it's going to be embarrassing. Boy, I was way off on that one. So there you get a much, that one makes more sense because it's lower than the others. So that means there must be some positive convexity there.
Are you guys in duration? What do you look to?
It's really tough for me because my career was when interest rates were much different. It has a huge impact. you're doing a 2-year bond. 2-year bonds, it's going to be between 1.8 and 1.9, so it doesn't really matter that much. When you get out 5 and 10, especially 30 years, the duration of a 30-year bond could be like 18 years. The further I go, and the more material it is, a small change in interest rates can change it pretty dramatically. And that's part of what convexity is doing, because convexity is reflecting the fact that duration changes as interest rates change. So duration is not a straight line, and it helps you. As interest rates rise, duration comes down. Interest rates fall, duration goes up. So it helps you. It gives you less price risk when rates are rising, gives you more price risk when rates are falling, which is exactly what you want. So that's why convexity is this positive skew. But yeah, it's hard for me to, I mean, I grew up when interest rates were like 15%, it's just hard for me. So I should go back and do some practicing. Right. Now, what duration is this? This is actually the Macaulay duration. So this paper I'm reading on duration, he says you should also adjust duration for the yield curve and for a reinvestment assumption. I was like, yeah, I agree with everything you're saying, but boy, that is a lot of work. So I mean, the math in this thing is like, yeah, boy. If you're doing this with billions of dollars, yeah, you want to be that precise. For our purposes, we don't have to be that precise.
So, F28, that number, is that the sum of that column or?
No, each one of these is a discounted cash flow.
No, so that, yeah, no.
No, the sum is, this one's a large number. You guys got $1,000. So 1,017.50 is worth 779.90 today. But the sum is 918.12. All right. All right. So on Monday, we'll do the team competition on bond valuation. I'll give you a previous exam. You know, it's going to be a 2-year bond, so I'm kind of giving that away to get some practice. This you can do on your calculator. This you could do if you know the formula. It's not that tough of a formula. The table you have to do. If on the exam you give an answer of 918.12 and it's exactly right, you get 0 credit. If I don't see the table. All right, that's how picky I'm at. I'm just convinced finance majors don't know what we're actually doing because everything's plugged into a calculator in Excel. So it's like, hire me and pay me $600,000. It's like, what do you know? Well, I know how to plug stuff into Excel. And they're going to be like, well, I'll just hire Bill Gates. Why should I hire you? You know, I need someone who actually understands what Excel is doing, not someone who can just plug stuff into formulas. So make sure you know what the formula is doing. This is what it is. That bond is nothing more in a discounted cash flow. You got to know what the cash flows are every 6 months. It's a coupon. You got to understand all of that. I mean, it's great to know the formulas as well. You will never use your calculator again after you graduate since you have Excel. It is nice to know Excel and what it does, but at the same time, know what the bond actually looks like. Now, what my friend is talking about, you could not do in Excel. Because he's actually talking about using a different discount rate for each one of these. Can you imagine how much work that would be? You'd have to put the yield curve in there, and he wants to use daily compounding, not 6 months. So he's going wild. He says, hey, it has a 1.3% impact on the price. It's like, and that's material if you're doing billions of dollars. Now he's saying this, he wants to do this for ordinal reasons. What does he mean by ordinal reasons? He wants to use his method to rank bonds based which ones he wants to buy. So my question to him is going to be, that's great. You have this ordinal method. Would it have actually added value to your portfolio? Because if it doesn't add any value to your portfolio, do you want to go through all the extra work? So he's got to prove that it's actually useful to do. We're going to do stocks next. You can do the same thing with stocks. Use a different discount rate for every dividend using the yield curve, but boy, that is a lot of work. So you have to ask, is it really material or not? All right, that's it for bonds, except for the team question we'll do. So let's get into stocks. Unless y'all have some questions, any questions on bonds? You get paid just as much as a bond analyst as for a stock analyst. You can specialize a whole lot more on bonds than you can on stocks. So there's people at Victory Capital that all they do is mortgage-backed securities. All they do is commercial mortgage-backed securities. All they do is munis. Very, very specialized field. And you get paid just as much. I mean, they get the $500,000 bonus, just like the stock guys do. There's more bonds in the world than there are stocks. I mean, as far as the size, when you think about IBM or Walmart, they have one stock, but they may have 10 bond issues or 20 bond issues. So there's more bonds out there than there are stocks. Plus municipals, what's the stock value of San Antonio City? They don't have a stock, but they got a bunch of bonds. So there's a lot more bonds out there. It's much more quantitative. So if you like math, bonds is a lot more interesting. And so, I mean, so don't, everybody wants to do stocks, but don't forget bonds. It's a pretty interesting field. Maybe I could get Nathan to come talk to us. Victory Capital hired him out of UTSA, and he's been there for quite some time. All right. So let's do stocks. So I stole this from Dr. Damodaran. Got to say his name correctly. I recommend you watch all of his videos. They're really, really good. He says this is the value of a stock. So he says, first, you take the present value of the cash flows of the existing business, what they're doing today. Then you look and say, hey, they're doing some new stuff. What's the value of that new growth stuff? And then eventually they do everything they can do and they become just a stable, steady firm, maybe 50 years out, 20 years out. So you got what they're doing today, what they're going to do new, and then eventually they combine what they're doing today, everything new they've done, and now you just got this steady state. The steady state is also known as the terminal value, the firm value 10, 15 years out. And then you have a discount rate. So he's saying that's what you got to do. You break the firm up in 3 pieces. We're actually going to do that. We're going to use what's called the H model that does that, which is a pretty cool model. So that's what he says you're supposed to do. He says cash flows. It all comes about what cash flows are the assets producing. So you got to look at the firm and see what other assets and what the cash flows are doing. If it doesn't produce a cash flow, it's of no value. All right, you have to have a cash flow. So Duolingo, what are they really famous for? You can get most of their product for free. What's the value of Duolingo, all their product for free? What would be the value of that stock? Be worthless. I mean, it's really nice that they're doing that, right? So what do they need? They need subscribers. 8% of their customer base are subscribers. And they were interesting. The podcast said a lot of subscribers are wealthy people in wealthy nations that are subscribing almost like it's a donation to a charity. But they're subscribing just so they can help Duolingo provide free software to poor countries. It's kind of interesting. But they do have $500, $600 million in revenue. So they are getting revenues in. That's interesting. The Dove proposition for an asset to have value, they expect capital to be positive over some period. They can't all be negative. Don't freak out. Assets that generate cash flows early in their life will be worth more than later in life. So you'd rather get the cash flow today than 50 years from now. That's kind of obvious. That's the big thing with AI. Right now, who's making money on AI? Well, it's the people that are selling AI. But the people buying AI haven't figured out how to make money off of it. So NVIDIA is going to sell AI chips to Walmart, but Walmart hasn't figured out how to make money on AI. Eventually, Walmart's going to have to make money off AI for it to make sense.
And what do you think about like Reddit? Because it's free. You only really spend money if you want to give someone.
I've never used Reddit, so I don't know how. Is that like the artsy people, or what are they doing?
It's more like a forum, but it's free. But they recently.
So it's got to be advertising, right? If it's free.
They're gonna have a deal with AI where they're gonna use the threads on Reddit to like kind of like teach AI.
Yeah. So the key for AI on a front, like, so it's like Duolingo. Well, I thought it was really cool because I'm trying to learn Spanish. Duolingo is going to use large language models so their students can actually go on Duolingo and have a conversation with the robot. And the robot's going to listen and say, oh man, your Spanish is pretty bad. I'm going to have you talking to a 3-year-old in Spanish, or someone else is more advanced. That's pretty cool, isn't it? That AI is going to have a conversation with you exactly at your level in whatever language you're learning. Would that be worth a subscription?
Yeah.
That would be. So now you have AI making money for Duolingo. Right now, that's really not the case. Right now, it's the people producing AI that are making money. Eventually, you got to get companies are making money. So that's going to be the whole thing. So right now, the people making money on AI today are those producing the chips. So eventually, you got to get that on the other side. Is Tesla going to make money on AI?
Yeah.
You know, eventually, we talk about Root in my P&C insurance company and P&C insurance company finance class, right? Camille, we're talking about Root. That's the AI insurance company. They're all about collecting data on you to figure out what kind of driver you are. It's all AI driven. It's just an impressive firm. So eventually you got to get a cash flow out of it. Or, I mean, it's the fact that it's really cool is that's not what stock people want. Like, wow, it's really, really cool. Well, where's your cash flow? Well, it doesn't make any cash, but boy, it's really cool. Well, like, you're not going to make any money off of it. All right, so we got to get growth rates, but before that, let's do some valuation, just get some practice. So let's get the formulas that we need. It's really straightforward. You should have done this in 3013. So let's do this as a practice. So you have a dividend. We'll call it dividend 0. And we're almost out of time anyway. So let's look at Walmart. So Walmart has a dividend. What dividend 0? What is dividend 0? Well, dividend 0 is the dividend they paid the last 12 months. And what is that? 19 cents plus 20.8. So there's their dividend. I don't know how they pay a 0.8 cent dividend, but somehow they do. I really don't know. If you have 4 shares of stock, how are you going to get your dividend when it's 77.8 cents? That's what it is. What's my discount rate? Anybody remember the discount rate for a stock? Most famous formula in finance. CAPM. What does CAPM say? Risk-free rate. Plus beta. Yeah, now most of your classes, it says times the required return on stocks minus risk-free rate. That's textbook. You won't do that in real life. That's what they do. Required return on stocks minus the risk-free. Y'all have seen that, right? In your classes. Stop thinking that way because they're going to look at you funny in interviews. No one in finance outside of academia thinks that way. We just call it the market risk premium. So try to get out of that textbooky because it.
Are most universities teaching it the way?
All textbooks I've seen do it with the minus in there, but I've never in my life in practice seen anyone say, "Oh, the required return minus risk." No, they do. If you go out the Motorin sites, he is a professor, but he teaches it like this. He doesn't teach it as required return. We're gonna have to do the required return. You're gonna see that on paper 3. All right. So for Walmart, I'm gonna use the 10-year Treasury for my risk-free rate. So the risk-free rate is today 10-year. What has the 10-year been doing the last couple of days? Shooting up pretty rapidly, hasn't it? 436. I'll just use 4.4%. The beta, what beta would you use for Walmart? I'll give you a choice between 0.6 and 1.4. 0.6, all right. And the market risk premium, you can go down to the Motoran, he'll give you his current rate. We saw what he had in that table. I'm just going to use 4% for now. Just to keep it quick. And so my KE is going to be risk-free rate plus beta times the market risk premium. So what we're saying is I need a return on Walmart of 6.8% or higher for me to be compensated for my risk in Walmart. That seems like a really low return, but we're saying this is a low risk stock because it has a low beta. It's going to protect you in a recession, so it has a low return. So what's the value of the stock? Well, we need dividend 1. So let's come up with a growth rate, and let's use a growth rate, say of 4.5%. We're going to talk quite a bit about growth rates here pretty soon. So what does that make my dividend 1? Dividend one is gonna be dividend zero times one plus the growth rate. So dividend zero times one plus 4.5%. So that's my estimate for the dividend next year. You might say, well, won't it be 2008 times 4? Maybe. Who knows? But we're going to use my numbers. So what is my value? We're going to use the dividend discount model or the Gordon growth model. And that's just going to say dividend 1 divided by KE minus G. How much simpler can you get than that? Pretty simple formula. So for Walmart, that's going to be 81 cents divided by 6.8 minus 4.5. We get 35 bucks. So we're not going to like Walmart at all because it's currently trading for 59.43. This is called the intrinsic value. That's what we think it's worth. It's the market value. If you had this on paper 4, what would you say? You'd probably recommend a sell on Walmart. You think it's overvalued. Now, how can we get Walmart to be better valued? Well, if you go to the summary page, one thing you notice real quickly is a much lower beta. Maybe we're using too high of a beta. So their beta is only 0.5 there. I use 0.6. So let's try 0.5. That's getting me closer. What else could be going on? Well, maybe the growth should be 5%. All right. So who knows what the assumptions are? That's what a lot of students do on paper 4. Say, oh, no, I meant to say 5%. And why did they do that? Because they feel more comfortable their valuation is really close to the stock price, which means it's kind of useless to do the exercise. If all you're going to do is back into the current stock price, then don't go through the valuation. I have no belief that Walmart is going to grow at 5% going forward, because they haven't grown at 5% in a long time. They've been growing at 2-3% forever. So I actually think 4% is a better number. I mean, what is Walmart going to do? When are you going to suddenly be running Walmart twice as much as in the past? Carlos?
So for growth, would you do like an average of how much they think?
We're going to talk about growth a lot. Yeah, so we'll get into it.
And just so I'm understanding this, so the dividend 1 can be any point in time. You just take in the dividend, the last dividend, you make that.
Well, you start with the dividend you expect the next 12 months. That's what goes in the formula. We're going to talk next class, what if they don't pay a dividend?
Okay.
Because dividend discount model is making a huge assumption that dividend equals free cash flow. The motor end says that's true for about 5% of the stocks in the market. So what we're going to do next class is, instead of using dividend, we're going to use free cash flow. And that's the thing we could do with Walmart. Instead of using dividend, we could use free cash flow. We might do that next class to see if we get a better valuation.
For dividend 0.
Well, dividend 0 is just whatever they paid the last 12 months. So for paper 4, all you're going to do is go out to their historical data and you just change it to dividends. And dividend 0 is just the sum of what they paid this last year. They pay quarterly dividends, so that's all it is. You just add those up. It's real straightforward. If I did this for Google, what will dividend 0 be? What's their dividend 0? 0. So is dividends a good approximation of free cash flow? Not for Google, probably not for Walmart. So that's probably the thing. If you look at Walmart, their dividends are probably well below their free cash flow. So that's probably the reason my valuation is far off. Have any of y'all have Catapacum yet?
Yes.
And he's the king of free cash flows. So, that's the key. So we'll have to adjust for that. On paper 4, you might do free cash flow instead of dividend. I'll give you a quick formula for that.